The first day of the conference went excellent, and I'm sure the second day will start as great.
Right.
So today, in this first session of 90 minutes, we have two speakers. So I suggest that to each of the speakers we allocate 40, no more than 40 minutes for the presentation, and roughly 5 minutes for some Q&As, but we are just flexible, it will take a minute. So out of the two speakers, the first speaker is Jonathan Batten. So please, Jonathan, I'm not going to spend much time introducing you. You can do this yourself if you want. The floor is yours.
Thank you, Igor. So thank you very much. Such a big audience, I wonder how much they paid you to turn up. So my understanding is you were bribed to come here, so thank you very much for coming. The top left-hand picture, so this paper is an extension of work that we presented here 2 years ago at this same conference. So, but I'll explain a little bit more about that context. So the work is with Harald and Niklas, who are in the audience, and Peter, who is at the CEU in Budapest. So the top left-hand picture shows you a product called palm oil. It's a tropical crop. I live in Malaysia, and this crop has been linked in with deforestation, all sorts of other and complex issues. But I'll try to explain what those issues are during the course of this presentation. Now you'll see you have a guy there on the right-hand side. Now one of the big issues with palm oil, and one of the issues to do with sustainability, is the fact that it's mostly harvested manually. And the viability of this crop is often, in fact, linked to the price you pay for this guy to cart the very large bunches of palm oil that you see growing on the tree. And so most of these guys are not local workers, which is one of the other problems. So you have two types of producers of palm oil. You have listed companies, which are mostly Chinese, and they rent the land from government. In the case of Malaysia, you have a ruling class, and so you have an old aristocracy in Malaysia, and they basically control all of the land, all of the like the trees and the forests, just like in the old days of feudal Europe. These people have titles like the Raja, you have a Sultan, you have all sorts of titles that are linked in with this landowning class in Malaysia. So that's the sort of kind of context that I'm talking about with this. So but there is, apart from the corporate interests that underpin palm oil, there is in fact there is a very large group of very poor people who plant palm oil on land that they themselves have inherited over the years. Now these people are vast. To put it in perspective, in the case of Malaysia is relatively speaking a developed economy. They produce many of the tech gadgets that you may have in your possession. They produce chips, they produce all sorts of things. But the bottom 20, what they call the B20 group, the lowest income group, are mostly agricultural farmers. The agricultural farmers have very modest incomes. And one of the big things that they do is they grow palm oil on their inherited land. Now, so let's look more at this topic. So really what we're doing here, this is like a case study. What we're looking at are two economies that are very dependent, whose economic outcomes are very dependent on an agricultural crop, which in this case is palm oil. What we're trying to do is look to see how their livelihoods potentially can be affected if you control the macroeconomic shocks associated with the production of their crop. And that crop, as I mentioned, is palm oil. So we show that Indonesia and Malaysia, which are the two largest producers of palm oil worldwide, and the Indonesians in particular You've seen the monkeys, the orangutan, being displaced by the local crop growers. So we show that the adverse Indonesian, Malaysian stock price movements can be reduced by hedging using two oils and setting up exchange rate hedges as well. Now, importantly, we show that hedging effectiveness is improved with market liquidity. Now, what that does is link into not that we wanted to do this, but the development banks have there's a very big literature in the development banks that says that in order to improve economic well-being, you need to improve financial market infrastructure. Improving financial market infrastructure invariably requires improving market liquidity, as well as the types of products that are available in the market. So these findings have big implications, as I mentioned, for the SME sector, the small and medium enterprise sector, the bottom 20 group, which are typically the lowest income groups in both economies. Now, the model, we apply some technology, an asset pricing technology. We look at this we identify strategies to minimize the two oils, the risks of the two oils, and we look at and come up with an effectiveness statistic to see how effective that is. Then what we do is we look at the impact of market liquidity, stock market liquidity, on that variable. So we show that liquidity matters, and this is correlated with hedging effectiveness, and as I mentioned, this has broader implications in terms of economic policy, which we are in the process of developing, but nonetheless happy to get your comments and feedback. And so that in fact can help the bottom group in these two economies in terms of poverty alleviation. There are obstacles, and I'll discuss those at the end. So if we look at the development literature, there are three main areas that have attracted papers in the last 20 odd years. The first is the role of socio-cultural factors and how that impacts on investment and financing. Now, as an example of that, in Malaysia, you have what is called a sukuk. Malaysia is the largest market for Islamic priced securities. These are called sukuk securities, and there are sukuk bonds, and the World Bank has in fact issued what's called a green sukuk, where the proceeds of the sukuk security has been used to finance sustainable investment. So that's the second of these is tourism and manufacturing, and the new area in this that's also attracting a lot of interest is ecotourism and sustainability. And the third one is this, what we talked about just before, about financial market infrastructure. Linked in with that is the access to finance and the financial inclusion debate. Now, in most of the developing world, the single biggest group that you need to capture in terms of financial inclusion are the rural poor, and particularly women. So women generally do not have access to finance. They're dependent on the financial arrangements that exist within the household, dominated by a man. In addition to that, the rural sector generally do not have access to finance physically because there's nothing available in the vicinity. And I'll give you some examples of this later on to highlight the scale of the problem. So importantly, what we're talking about is that the development literature the development literature talks about access to finance and the limits to finance and trying to solve those problems, but it doesn't really talk about one of the key issues, which are using financial products to manage the risks that underpin the use of these markets. In the context of what was done or spoken about yesterday, with the green climate and green finance and sustainability are all areas that are generally underrepresented in this literature. And so if any of you have any interest in this, these are topics that can, well, obviously very important for the next few years. Okay, so we look at how best to address this largely overlooked area of commodity price impacts. We do not disentangle the price drivers. It's not a paper about saying this causes the prices to go up or this causes the prices to go down. What we do note, however, that there are certain key features of these price shocks that need to be considered. So, for example, if you have an oil shock, then this flows through to shocks in the stock market sector. It affects palm oil prices because palm oil is substitutable for crude oil. But I'll show you in pictures these relationships. So as I mentioned, we're trying to sell this paper and this idea in terms of much wider implications. It's like a case study looking at these broader UN development goals. All right. The technology that we're using, as I mentioned, is based on a capital asset pricing model, an international capital asset pricing model framework that we presented here 2 years ago. Now that is forthcoming in the journal called Energy Economics, if any of you are interested in looking in detail at the technology. But it's available there. Same authors, just forthcoming paper. Now, the linkages between energy and asset prices, there's obviously been a lot of work done on this in the past. In 2016, Ben Bernanke, the former Fed Treasurer, the Federal Reserve Bank Chairman, he pointed out some of the problems to do with these linkages and the fact that the historic relationship between energy prices and asset prices was becoming unraveled. For example, you all have done some finance. You understand that we think about prices as expectations about future earnings, so net earnings. So if the oil price rises, you would expect that that's a cost to industry, so therefore stock markets should fall. Now that has historically been the relationship for probably 20, 30 years, but that's not the case in the last 20 years. In fact, it's quite opposite, it's quite often the reverse. Oil prices rise as a signal of an increase in domestic consumption, and then that flows through as a signal to, well, stock prices are going to go up because profits of these companies are also going to go up. So the linkages, that what we thought were the linkages and explainers maybe 20 years ago, no longer apply in the current setting. So we need to rethink the relationships that exist, or the dynamics of the relationships that exist between all commodity prices and then financial assets such as stocks, gold, and so on. Now, I mentioned that Indonesia and Malaysia are the two largest producers. I'll show you some statistics of that in a second. They are also have different degrees of economic diversification. So Indonesia is still fundamentally, it's a huge economy, 200 million people, predominantly Muslim. Malaysia is also predominantly Muslim. You have a tech sector and an industrial sector in Malaysia, which is dominated in the south and on the island of Penang, and they produce electronic gadgets like chips and so on, microchips, computers, things like this. That technology is not available in Indonesia, but the agenda here is there are huge long-term implications. As part of what they call the One Belt, One Road program, which is China's foreign direct investment expansion globally, there are going to be linkages. You will be able to drive from Singapore to Istanbul and take a train from Singapore to Istanbul within probably 10 years. So when all of that infrastructure is complete, there will be this huge connectivity between basically the road and sea routes in the east and the Europe in the west. Now, of course, there's debates in this country about those relationships, which I will skip, but nonetheless, they are very relevant here as well. All right. So this is all Asian economies have declining, their economies are diversifying, and they're slipping from being agricultural producers of rice, rubber, this sort of thing, until and they're manufacturing economies. But nonetheless, you can see from here, this is the percentage of agricultural exports. All of these countries are less export dependent now on agricultural products, but the key thing is that the people who most are affected by declines in prices are the rural poor. So this kind of gives you the wrong signal. Just like China, the west of China is where you have the rural poor are all based in Western China. The cities, the coastal cities is where all the wealth is. So too in most of Asia, you find that the cities are where the wealth is and the countryside is where the poor people live. And they have limited access to education. They have issues about financial inclusion, all of the problems. So in terms of UN development goals, you should be targeting those groups of people, not worry so much about what is happening in the cities. Nonetheless, the role of these, particularly palm oil, has been increasing. And the welfare of these people is heavily affected by changes in the price. So, for example, this is a group of local farmers harvesting palm oil. When the price falls, then their welfare is obviously affected. Now, the thing is that the supply chain of palm oil is complex. You have guys who grow it, big companies as well as small companies. The palm oil gets harvested, gets put on the back of that truck. Some of it is licensed as being sustainable. So there's a licensing system now to separate out production that is on plantations which is not destroying orangutan and wildlife and so on, and other plantations which are slash and burn, where they're planting the palm oil on virgin forest that's been removed. So there is this licensing process which is happening at the moment. These guys transport that to an oil refinery. Those people then extract the oil. Now the key thing is that the profits of the production side are all kind of like locked in by the manufacturers. So if there's a change in the oil price, a fall, they push that down to these guys. So they get squeezed in terms of their profits, or the income that they receive in terms of production. They're the bottom of the supply chain. In the case of Malaysia, there's 650,000 small block holders. Now these are extended families. You have grandma, grandpa, you have kids. So you typically have 3 generations living on a plantation, so a minimum of 10 people. So typically these small plantations of less than 10 hectares are the only income source for a family of 10. So roughly 6.5 million people, roughly 15 to 20% of the population of Malaysia. So they, as I mentioned, represent the rural poor. They're the bottom 20% in the society. This is the average palm oil price in US dollars, and you can see that has been falling. The high price back in 2010, 2011 is, I'll show you in a second, that is largely, there are 2 components here. Palm oil is both a food, used in cooking. It's a high heating oil. So if you do stir-fry veggies, you need an oil with a high burning point, and so palm oil is the preferred oil for that. But it's also used for manufacturing chocolates, for manufacturing cosmetics, all sorts of things. Okay. Of course, what causes the palm oil price to fall or change? Now, this links in with the sustainability issues. And you can see that Peru banned palm oil deforestation. So palm oil is actually, per hectare, the most efficient producer of oil. So if you have, out in the countryside here, you have safflower or canola oil. You see the yellow fields, not the sunflowers, but the others. Rapeseed is the other term for this. That oil is one of the lowest yields per hectare in terms of oil production. So palm oil is a very efficient producer of oil. The issue is its lack of sustainability. So the trade war, all sorts of things that create these events create shocks in terms of prices. Here we have an orangutan on the left-hand side, and you can see that this is, even though, so soybeans, mostly coming out of America, are the single biggest source of vegetable oil by a huge amount. You can see that palm oil is, relatively speaking, a smaller amount, 16.5 million tons of production in 2016-17. But whereas rapeseed, cottonseed, and peanuts have been declining in terms of production, you can see on the right-hand side circled that the amount of area of coverage under palm oil has been rising. And that is the unsustainable part, because that production is mostly in Indonesia, and the Indonesian production is at the expense of rainforest. So that's where that's where the key problem is. So production in the case of palm oil is largely linked with deforestation. All right, this is price volatility is the single biggest issue for farmers. If they know the price is going to be high or low, they can adjust production accordingly. But when they sow the crops or plant the crops and the price goes up, that's great. If the price then falls, they're devastated because they can't produce. So it's price volatility is one of the key issues. Now, I'll skip that one. If you just did a general plot between palm oil and Brent, Brent is the international price for crude oil. We have two main types of crude oil. We have West Texas Intermediate, which is the oil produced in the United States, and then you have Brent. Brent is mostly the oil produced in the North Sea. So this, in terms of an international price, Brent is the one that you use. You can just see, just using a simple linear regression, that there is this time-varying but generally positive relationship between palm oil price and crude oil. And if we use more sophisticated econometrics, you can see more clearly this time-varying correlation. So this is a dynamic DCC correlation, or the produced from a Garch type model. And you can see that in recent times, in 2010, when the price of crude oil was very high, just post the global financial crisis, you had a very high correlation between these. And that's the correlation in US dollars, and that is the correlation between the Kale Stock Exchange to palm oil in US dollars. So basically the stock markets in these two countries are very, very susceptible to the changes in the price of palm oil. Now, to those of you who have done some finance, that basically means these firms are not hedged. So if you are able to hedge away the risk, then theoretically you would not be sensitive in this sort of way to these price movements. Now, one of the big things, as I mentioned, is this linkage with between crude oil and palm oil, and the reason for that has to do with biodiesel. If I show you 1 litre of palm oil, that can be converted approximately to 1 litre of biodiesel. So the process is relatively straightforward. So if the price of biodiesel rises, and there's a demand in Europe for biodiesel to meet sustainability targets, then that will also affect the price of palm oil. And the reverse is also true. So in the case of the US, in the case of Asia Pacific, these are small open economies. The commodities, exports are not priced in local currencies. So within Europe, the forint is the currency of Hungary, and the relationship between the forint and the euro varies over time. So if you're a exporter in Hungary, do you price or invoice in forints, or do you price and invoice in euros? So depending on your currency of invoice, that has risk management implications. And trying to control for those is one of these important issues. All right, let me skip and I'll just show you some pictures. So we argue in the paper, how much time do I have left? 12 minutes, okay. We've got time to show you some detailed results and some pictures. Okay, so in terms of policy implications, so we're arguing that access to risk management products is one of the big things here that needs to be addressed. So how do you go about doing that? What are the issues associated with that? Financial literacy is one of the key things that will impede this. So you may, if you're a farmer out in the jungles growing your palm oil, you're not going to have access to online databases. You're not going to be able to make price decisions. You're not going to be able to buy or sell options. At best, you might be able to buy some insurance if that can be priced appropriately. The other issue has to do with collective pooling of pricing, which is not a. So, for example, in China, rice production in China is produced at a fixed price. You have the collective farms produce the rice. There is a government agency in China that takes the rice, and even though there is an international movement in rice prices, those guys do the hedging and risk management. So from the point of view of the farmers, they get, say, 100 RMB local money yuan for their per kilo or something of rice, or per 100 kilo of rice. So they can make their production decisions based on knowing that they have a fixed price, and they know that there's a profit based on their production. So the only issue for them is things like climate change effects, where they don't have rain, they don't have this, they don't have that. So, but the pricing and selling of their product is not something that is a concern for them. That is not the case in the rest of Southeast Asia. All right. So the idea of some sort of pooling as well as risk management may be some way to alleviate the poverty issues that are faced by these farmers. Nonetheless, this is not a popular policy option. So if you go to the World Bank or the Asian Development Bank and say, look, we think there should be collective pooling, government intervention, it's like you're telling them that this whole thing should be a communist country, and this is not. It's like preaching that in America. You can imagine the sort of reception you would get. So it's very much the same thing in Asia. So the development banks are very, very right wing and pursue development agendas which are, well, not necessarily that I agree with. All right. Let's. Okay, just to give you an idea of what we're talking about. When you hedge something, you have two assets. What you're interested in is the relationship between those two assets over time. Now this gadget doesn't zoom in, but so on the left-hand side we have the hedge portfolio. So the hedge portfolio is effectively a two-asset portfolio. The first term, RST, is the spot, in this case an asset that you're trying to hedge, and it's a cross hedge. You're not hedging it with a product of the same type. You're using, say, one asset to hedge another. So therefore what is of interest is the beta. The beta is this time-varying relationship, and to those of you who have like theoretically you can hedge one asset using another asset, where we were aware of the fact that the beta is in an asset pricing framework varies over time. So you get the idea of we have this time-varying relationship. Now we can do this using complex econometrics. I'll skip, but you can read about it in the paper. But I'll just say that we have this time-varying beta, and we use the most appropriate technology at the moment to determine its value. So so the idea is this one. If we have a long stock portfolio, what is of interest to us is the change in S. Now we can offset that so one's a long position, the other is a short position. So the intuition is we have the red line is the stock portfolio, the blue line is the oil or the asset we're using for the hedge. So therefore the hedge portfolio is that relationship there, where beta is the time-varying sensitivity of one asset to the other. It's also possible to use a put option, so you can buy insurance. Now the nice idea about insurance is that you protect the downside and leave the person with the potential upside. So if we combine the red and the blue, you will see the standard call option strategy where you have a floor on the price, which is the minimum price that is received by the grower, and then if the price rises, then they can enjoy additional profits. So that is the overall position if you have a floor. Okay, I'm going to skip all of these because we don't have time to go through them all. Okay, I'll get to show you this one. So the first one, we come up with this idea of a hedge. We want to know how effective it is. And so the effectiveness of the hedge is simply, we look at the beta, we have the square of this time-varying beta. We look at the variance of one asset compared to the variance of the hedge. Now the intuition is that if this is a perfect number, if it's a perfect hedge, it will be 1. And if it's not a perfect hedge, it's a 0. So let me just show you a few things. So this is the hedge effectiveness of the Kuala Lumpur stock market. It's the KLCI, the Kuala Lumpur Composite Index. So we're using these indices because we need market prices. So we're arguing that the wealth is effectively the time-varying wealth in the economy is effectively represented by something like these assets, the stocks in the market. Now that's in US dollars. And so you can see that this is if we hedge the index using US dollars. So in other words, you need to worry about exchange rate risk as well as commodity price risk. Let me show you another one. This is the hedge effectiveness of the KL Stock Exchange if we use a two-asset portfolio comprising an equal mix of Brent, which is the crude oil, and the palm oil. So you can see that again we have this time-varying relationship, but importantly during periods of, there are certain periods of crisis, like that period around 2008, 2009, these hedges do very, very well. So in other words, the sort of price shocks that could potentially affect the economic welfare of the SME sector, If you were able to control for that and hedge away that risk, it would be very beneficial to these people. That's the idea. This is more so with the Jakarta Stock Exchange. And now I'll just show you some liquidity effects. Now there's a number of ways of measuring liquidity in the market. There are two very popular ways. The first of these, the yellow line, represents a paper published in the Journal of Finance a few years ago, not too long ago, called Corvin-Schultz measure. And you can see that if you look at the KL market and the Jakarta market, over time, these markets have improved in terms of liquidity. So this is a plus for the development banks who are saying that that you need to develop these economies, and if you develop the economies, the financial markets of these emerging markets, then this will provide benefits. One benefit is improved liquidity. Now, so the liquidity is a lower number, not a higher number. So I should have said that. So because the measure here is based on the difference between the bid price and the sell price in the market. So I'll give you an example. If you go to the money changer at the airport and you want to buy US dollars or you want to sell US dollars, they have two prices. They have a buy price and a sell price. Now at the airport, the difference between the bid and the offer is probably 20%. They're stealing your money. They buy at one price, at $1, and they sell it at $1.2. So they're taking 20% margin. So that is an example of a market where there's very little competition. On the other hand, if you go to some of the money changers around the streets here, you'll find that those spreads are much tighter because there's more competition. So this is the same intuition here. When you have more competitive and better markets, the spreads between the buy and the sell price are lower. So this measures effectively liquidity, and you can see that irrespective of how we measure it, using a roll measure, the blue one, or the Corvin-Schultz measure, that there has been an improvement in liquidity in these markets. If we then run some regressions where we look at, what have we got here? We've got the beta, in this case here, the beta of the Jakarta Stock Exchange and the hedged by palm oil. And we're looking then at the relationship between the two measures of liquidity. So you can see that in this case here, the roll measure shows a positive relationship. Yep, a few minutes. 1 minute. And the same with that's the Jakarta market, that's the KL market. So in other words, liquidity is linked in with effectiveness of the hedge. That's the key takeaway here. All right, skip that. So what does this say? The results show that the time-varying liquidity effects are also correlated with hedging effectiveness. That's a key policy issue. We're saying that the commodity price risk, not the dollar risk, is the one that's most important, because we have more results which we haven't had time to look at. And so therefore this links in with the liquidity issues for financial markets. So for example, more advanced and open economies have greater stock market liquidity, and therefore they have by default, huge improved hedge effectiveness. Okay, so let me show you some pictures to sum up what we're talking about. Okay, this is an orchard in the jungles not far from where I live in the north of Malaysia. Now, these guys here are small crop producers. The tree on the left is actually a fruit called a durian tree. It's a big prickly thing that's very expensive, and people are happy to buy it. Some people like them, like me. Other people loathe them. They're very smelly. that's the sort of, that's the farm type environment that many of these people live in. You know, there's water supply. So the key point is the orchard has abundant, there's abundant water, you've got lovely fruit growing. So it's one of those circumstances where perhaps you don't need to necessarily have a lot of income because you can grow a lot of your own food. So these people may be poor, but they're not hungry. Like that's one of the issues. But one of the key things here is their access to finance and banking services. So let's say they wanted to, these crops are seasonal. So that means they have income in one lump once a year or twice a year. Let's say they want to grow something other times of year. If they want to grow something during the other times of year, they may need some finance. That's the problem. They can't do it because they're unable to access that type of finance. So here, beautiful location, no electricity, no Wi-Fi, no internet banking, no fintech options available. So the sort of things that may be accessible in you know, the fintech solutions that you see talked about in London and so forth are not options here. So these are the sort of limitations that you face in trying to alleviate poverty in these sorts of areas. So the policy options here, we're arguing that it's absolutely critical that these guys access insurance type products to hedge away one of the key risks that affects their economic welfare. And the key risk here is commodity price risk. And so and in terms of collective, I'm Australian, there used to be in Australia a system whereby farmers sold their wheat. Australia was one of the world's largest exporters of wheat. Farmers sold their wheat to an agency that then managed the price and exchange rate risks and then sold that overseas, exported the wheat. So the farmers were getting not exactly a fixed cost, it did vary, but they were actually receiving Australian dollars. They were not liable for the US dollar exchange rate risk associated with selling wheat. So I believe that these are policy options that should be re-explored. Thank you very much.
Okay, thank you, Jonathan.
Yep.
I was expecting more technical stuff. And to show this whole area of policy implications. So it's a nice to see that. Finance and beyond.
That's right.
Okay, so a couple of minutes. We have some time for some questions from the audience. You be able to speak up or read the mic? Maybe. Yeah. I think you have a mic.
Thank you for your presentation. It was very insightful, and I think it was a perfect start for the second day of this conference.
Thank you.
If you could just please go to a slide where there were that showed the two measures for the liquidity of the two stock markets. Yeah, this one.
These ones, yeah.
Yeah, this one. Exactly. So it caught my attention that in 2002 there seems to be a sharp increase in liquidity using the Corvinus measures, and I was wondering about the reason of that. So, if you have any reasoning for that, it would be interesting.
I have to confess, my co-authors will look into this for you. No, we haven't. What we haven't done is I can make some suggestions. You have to understand that back I can't say to you that this was one policy option by the World Bank or the Asian Development Bank that helped, but I'll just tell you some history. So back in 1998, there was an Asian crisis, like a global financial crisis that affected Asia. Then what happened? You had the SARS crisis. So SARS was like a flu, and it caused all of the markets in Asia to collapse. Stock markets, housing markets, etc. And people were rioting on the streets during the Asian crisis, but no one went on the streets during SARS because everyone was worried about being sick. So then what happened in this period immediately after, the Asian Development Bank launched a series of initiatives to basically expand financial markets, because the Asian region has historically been heavily dependent on foreign capital inflow for their corporations. Now, it's a unique story. This is something that most people don't know. If you look at capital flows into Asia, Asia is actually a source of money because they're largely exporters. So they are a source of foreign currency. The problem is that they have most Asians have no faith in the local banking systems. So what they do is they put their money with foreign banks. And if you look at the Bank for International Settlement data, you will see that the reverse then happens. Foreign banks like Deutsche Bank, the big French banks, the AAA banks, they receive the money from Asia and then they re-lend it into Asia. So basically in the period immediately after SARS, there was a massive flow of money into Asia from the Western world, partly linked in with the direct response in terms of policy options to the Asian crisis and SARS. So that's why I would imagine there was this increase in liquidity. So it's all linked. So linked in with that was the broader development of financial markets, basically. A big, huge increase in the size of financial markets.
Great. Just one more thing.
Yeah.
So I see that using the Economies measures, it shows indeed a sharp increase in liquidity. And so I'm not really familiar with those two measures, so maybe if you could explain to me or us what's the difference between the two and why the raw one does not reflect such a sharp increase?
So the Corvin-Schultz is the one that, Richard Roll's one was an old measure. The Corvin-Schultz is the sort of whiz-bang new technique. So basically, as I was discussing, it represents the difference between the buy-sell prices in the market. So the wider the spread in the markets, the more illiquid the market. So if that number is high, then that means there's a great deal of illiquidity. If the number is small, there's a great deal of liquidity. So the liquidity improves as the number falls. Yeah. Any other questions? No one cares about orangutan in this room?
Okay. No?
All right. Thank you very much. Thank you. Okay.